I hope everybody's managed to get onto the webinar this morning, and I hope you're all safe and well, and looking forward to a really interesting session coming up. Firstly, I'd like to acknowledge the traditional custodians of the land on which this meeting is held over many lands and pay respect to their elders, both past, present and emerging. I'm David Chambers, Head of Member Services at the Australian Investment Council, and I'd like to welcome you to the latest in the knowledge series of our webinars. Is the IPO boom here to stay? We've assembled an expert panel from Rothschild, Advent Partners and Silk Laser Clinics to share their knowledge and experience with you today. To kick off the webinar, we'll have a presentation on equity markets and IPO activity, setting the scene for a panel discussion where you will hear the perspectives from a fund manager and CEO from a recent Australian IPO, Silk Laser Clinics. That will then be followed by an audience Q&A session. So please send your questions throughout the presentation using the chat feature on the Zoom that you've got. And time permitting at the end, we'll get to all of your questions. All participants will be placed on mutes for the whole of the webinar, so the communication has to come through the chat. We'll also send a survey at the end of the webinar today, so hopefully please give us your feedback so that we can improve our services moving forwards. But I'll go straight on to introducing you to our presenters today. Firstly, we have Stuart Detman, and Stuart is a Managing Director at Rothschild & Co. and Head of Equity Advisory in Australia. He has over 20 years experience in equity capital markets, including 10 years in equity underwriting and distribution roles. Stuart's IPO experience includes advising Link Group on its 946 million IPO and Partners Group on its 550 million IPO of its global income fund. We've also got Brad Lynch. He's a partner at Advent Partners and has over 18 years investing experience, including origination, execution, and active management of portfolio companies across software, healthcare, education and training, and consumer markets. Brad is currently a director of Silk Laser Clinics, Flint Fox International, Junior Adventures Group, and Mando Media. We've also got Martin Perelman, who is co-founder and CEO of Silk. Having worked in various national roles in the retail industry, he's acquired the relevant skills required to successfully lead a growing business, including sound financial management, brand development, innovation, sales and marketing strategies, and team leadership. Martin is passionate about identifying new growth opportunities for the business while protecting and maintaining brand credibility. So thanks, gentlemen, for joining us today. I'll hand over to Stuart now, who will take us through his overview of the equity markets and the IPO market at this stage, and then we'll bring Martin and Brad into a panel discussion after the presentation. So thanks, Stuart, over to you.
Thanks very much, David, and good morning, everyone. As David said, I'd like to start by just giving some perspectives around the current IPO and equity market environment. And then I'll look a little bit into the crystal ball for 2022 and give some perspectives and thoughts on what the IPO environment might look like going into next year. In terms of equity market conditions generally, markets have rallied very strongly over the last 18 months. You can see the chart here mapping the ASX 200 index against the S&P 500. The US market is trading at all-time highs. That's the Dow, the NASDAQ and the S&P 500 again overnight hit all-time highs, while the Australian market's trading around 4% below its all-time highs. You can see here that the Australian market has underperformed the US market by some measure. And a lot of that's got to do with the fact that the ASX 200 is underweight technology. Only 5% of our market is in technology versus 28% of the S&P 500 index. And that technology index in the US is up 76% since January 20. And then compare that to our market, where about 25% of our market is in the banks, BHP and Rio. And those stocks are up about, on average, around 6%. So that accounts for a lot of the underperformance of our market versus the US. The strength of the market, it's really being supported by historically low interest rates, and strong corporate earnings. So the US is just going through the corporate earnings season at the moment. 83% of companies that are reported to date have beaten market consensus. So that's a very strong result in the US, and it's actually beating, it's a lot stronger reporting season than the market is expected, and that has seen markets rally strongly in the last couple of weeks. There's a significant wave of money going into the markets as well because of record dividends, buybacks, and M&A, which I'll talk about. The key risk to equity markets, which you've probably all heard, is inflation, and if that remains high and persistent and not transitory, and that could force central banks to have to raise interest rates sooner and faster. And the US Fed is meeting today and tomorrow. Will be releasing a statement tomorrow on their view on tapering of quantitative easing, potential interest rate rises and timing for that. That's going to be closely watched by the market. Looking over the next page, just to give some perspectives on sector performance and valuation of the ASX. Tech index in Australia has been the major outperformer, up 65%. And as I mentioned, the US over the same period, up 76%. So we've been broadly in line, but three stocks, Afterpay, Xero, WiseTech account for about 65% of that tech index. So a very concentrated index. Utilities and energy have underperformed. Otherwise, there's a range of sectors that are in the green in the industrial, healthcare, financial sector. If you look on the right chart, just the valuations, and these are next 12-month PE ratios. You can see this is over the last since January 20, pardon me. There's been a very broad range of valuation ranges over the last sort of coming up to 24 months. And in many sectors now, valuations are trading towards the upper end of that range. And we're seeing that across, the sectors that are not are the materials, resources, and the energy sector, but otherwise it's mid to upper end, top end range for all sectors on the ASX. In terms then of IPO activity, we've seen a very strong quarter of IPO activity. Actually, quarter 4 this quarter will be the strongest quarter for IPO activity in 7 years. And what is characterising the current environment is the number of large deals, and I've highlighted those on the page here. It's likely to be an IPO market that sees 5 billion raised in this quarter, and there will be three issuers raising close to $1 billion or more in their IPOs. So it's on track for the biggest year by value since 2014. We've seen coming to or having successfully lodged prospectuses or listed as Judo, GQG, Partners, Vulcan, APM, and SiteMinder. Ventia is in the market at the moment with lodged prospectus, and Comfort Delgro is expected to come to it's marketing at the moment, but expected to lodge a prospectus shortly. So there's a private equity owner, US private equity owner in APM, and obviously in Ventia as well. Apollo are a shareholder in Ventia. Turning over to the next page then, looking at aftermarket performance here. Interestingly, there's been very strong demand here for IPOs, notwithstanding the mixed performance of IPOs over the last 2 years. So you can see here on the chart on the table on the left-hand side that the average return of IPOs, I've just used greater than $75 million as the cutoff. That if you look at the performance, average performance has been 14% above IPO price, but the median has been about even, about flat. And so we've had as many winners as we've had losers across the market. What is driving, despite a mixed performance in the IPO, what is driving very strong appetite at the moment, and going back to this previous slide here, the strength of the demand, which we'll talk about here around these 7 IPOs, is really a very accommodative equity market environment. So as I've talked about before, strong performance of the Australian market, particularly strong performance of overseas, which sends a really strong sentiment around the world in terms of equities. There's been significant cash paid out to investors in dividends, buybacks, and M&A. And so record dividends this year from Australian companies, large buybacks, and we've seen some very large cash M&A deals on the table. That is all going to be deployed back into the market. We're seeing a little bit of valuation sensitivity from investors in the IPOs. So a number of deals have priced towards the low end of their pricing range. We haven't seen any large deals needing to reprice, which is positive, but in the range that has been preliminarily published to the market, it has been towards the lower end of the range that these deals have priced. But still, that's a very, very strong result. In terms of looking at the performance of private equity, I've highlighted in just the little red dots on the side of the table, those that are private equity-backed IPOs, and call out here very good performance from Silk Laser Clinics, up 28% since its IPO at the back end of last year. But if you look, the performance there of the private equity IPOs has been about consistent with what we've seen in the market. So about the same number that have traded up as have traded down, and an average performance of about 12%, which is, so that's what we're seeing is private equity-backed IPOs, similar performance to the broader market. Looking at some features we've seen of recent IPOs, issuers are capitalising on the strong investor demand to de-risk their IPOs by undertaking cornerstone processes. So this has become a very common feature of the current IPOs. So GQG, Judo Bank, Vulcan, Ventia, APM, and SiteMinder all undertook cornerstone offers in the lead up to their IPOs for up to 80% of the offer size. So that's a significant de-risking of IPOs before the prospectus is being lodged. Now, how broadly those cornerstone offers have been is some of them we know have been a half dozen investors. In the case of Ventia, they've gone with one, which was Capital, have taken a significant shareholding in Ventia, whereas others have been a dozen, slightly more in that cornerstone book as well. We've also seen retail demand for IPOs having improved. There was some indigestion in the first half of 21, a lot of small deals coming to market. The retail brokers were very focused on those transactions, and so therefore demand for some of the larger deals out of retail was softer for a period. But we've seen retail come back strongly in the second half and supporting these larger IPOs. Another feature we've seen more recently is issuers becoming more comfortable to provide prospectus forecasts for 9 months or more as the COVID-19 restrictions lift and they become a little more confident in the outlook. So at the same time last year, if we go back and look at the deals that were pricing in Q4 of 2020, many issuers declined to provide any forecasts at all, or shortened the forecast period to less than 6 months. And now we're seeing, in the case of Ventia, they've gone out to December 2022. So they've gone out maybe 14 months. So we're seeing more confidence around issuers providing forecasts. And it's notable that actually in the FY21 results reporting season back in August, and that was during the middle of lockdown, 60% of companies in the ASX 200 index did not provide any forward guidance at all. So we've seen a big shift in only sort of 3 months in terms of comfort that corporates have around providing forecasts and guidance to the market. So I think then looking at the question is the current boom here to stay? We do expect the IPO market to remain strong into 2022. Positive equity markets leading into Christmas should be supportive of new issuance into 2022. History has said that 75% of the time, going back 50 plus years in the US at least, markets are positive in November and December. And so you never rely on that sort of data, but the environment feels positive heading into Christmas, and that will be supportive for new issuance. But an important sentiment driver really is the aftermarket performance of these large IPOs that are listing now. So of those 7 that I just talked about, Judo Bank has listed as up about 8%. GQG Partners is up, down slightly, and others are due to come to market shortly. So how they trade in the aftermarket will be quite an important sentiment driver going into the new year, just given the size and the profile of these listings. We will see, as I've mentioned before, recycling of cash returns from dividends buybacks. So we had 41 billion of dividends paid out in the last results reporting season, 15 billion of buybacks. And M&A, we've got Sydney Airport, Spark Infrastructure, a couple of smaller deals. So there's a lot of cash coming back to investors that should find its way back into the market. And so we think investors will continue to seek out IPOs as a way to generate returns, given that money needs to be deployed, and valuations, as I mentioned earlier, across many of the sectors are towards the upper end of their recent ranges. So if they could get themselves set in an IPO, which may come at a slight discount to its trading level, then that can help with returns. The IPO pipeline is building going into next year. There's a number of sizable transactions that are in the offering, and also we do expect some PE-backed listings coming to market next year as well. One feature that's been quite interesting over the last couple of years is the significant expansion of pre-IPO capital raisings, and there's been a number of funds that have raised pre-IPO capital, pre-IPO funds. They want a liquidity event within 12 to 24 months of investment for their investors. So there's a lot of these companies that are likely to look to the market in 2022 and 2023 for liquidity events for those investors. In terms of what investors are looking for, it's companies with strong market positions in industries that have got underlying growth, or companies that are creating industry disruption. We're seeing a lot of those coming to market at the moment. They have strong top-line growth opportunities over the next few years, not just the forecast period, but evidence what they can achieve beyond that, and experienced management teams. So Judo is a great example of a small to medium enterprise lender challenging and disrupting the major banks. It's got no bricks and mortar business. It's technology enabled. It's got strong growth coming through over the next 3 years and a very experienced management team. So it ticked all the boxes for investors, which is why it was well supported in IPO. Sectors that are exposed to the reopening trade will also attract investor attention. And ESG, we can't discount ESG considerations at the moment being given increasing priority. And that transition for ESG has been over the last 12 to 18 months, and it's now a very important consideration, particularly at institutions, but also amongst retail. As I mentioned before, inflation does remain the key risk. We know that IPO windows open and shut quickly, so it does highlight the importance of being ready if you do want to list. So and then in terms of preparing for an IPO, just last page, in terms of thinking about an IPO, what are some of the readiness considerations? Well, firstly, it's the business plan and equity story. Making sure the business plan's up to date, as this forms part of the basis of the equity story. And would that be enhanced by further acquisitions or divestments in advance of IPO? Anticipating what the areas of concern are for investors, what they're going to be their areas of focus, and how do you think about addressing those early on? In terms of structure and financials, is the corporate structure suitable for listing? Do you need to incorporate a new company, new top entity, or do you need a SailCo structure to facilitate a sell down? Financial information is important. Base case is 3 years audited. Financial information, there is flexibility there a bit, but that's the base case. And the forecast period is flexible depending on IPO timing and to what extent the company has a reasonable grounds for forecast, but this needs to be given thought well in advance. And are all the systems in place, accounting, legal systems and controls appropriate for requirements as a listed entity? Some of the final comments are around readiness. Does the management team need to be supplemented to meet the requirements? For the board, who are the right candidates from both an independent perspective but strategic perspective, and when are they appointed? Are debt facilities also appropriate for the company, and can they facilitate transition to a listed entity? Pre-IPO dividends that could be paid out, and what is the right timing window, having regard to where the business is today and the outlook? There's two key timing windows every calendar year: March to July and September to November. We're in that last window right now, but thinking about the right timing for your business is very critical to making sure you hit the right window and have the right story to tell to investors. But overall, I think that and the environment has been good for the last 6 months, and heading into 2022, we should continue to see a strong environment for IPOs. Back to you, David.
Stuart, thanks so much for setting the scene for us and a very thorough review of the current markets. And hi, Brad. Hi, Martin. Thanks for coming back to join us. We'll kick off a bit of a panel discussion now. What I'd like to remind the audience is we will have a Q&A at the end of the session. So if you've got any questions or think of any whilst we're having this discussion, please send them through on the chat feature, and we'll get to them at the end of our panel discussion. But welcome, Martin and Brad. I'd like to kick off, Martin, if you could just spend a minute just to give us a bit of an overview of the Silk business from when it was established through to probably up to the point where Advent got involved in the business, and we can chat to Brad after that a little bit about Advent's thoughts. But if you could kick us off there, just for a bit of background for the audience, Martin.
Yeah, sure. Thank you, David. I'll try and keep it to a minute, but I'll see how quickly I go. Look, Silk Laser Clinics is a full-rounded cosmetic clinic now. We have 118 clinics located across Australia and New Zealand. We started in South Australia as purely a laser hair removal clinic all the way back in 2009. And we were growing roughly at about a clinic a year. In late 2017, early 2018, we brought on Advent as our major sponsor and private equity, taking a majority share in our business. Advent brought the knowledge and skills to help formulate our board and put together a pretty strong business plan for us to grow from then 12 clinics to 60 was sort of the goal in a 3-year period, and also diversify our service offering. We were starting to diversify, but we wanted to make a real pivot into being a predominant cosmetic injectables business with our other services and becoming a full service cosmetic clinic. Fast forward 3 years to December 2021, we listed at 56 clinics, and cosmetic injectables had become our number one turnover part of our business. And we sort of morphed into a full service cosmetic clinic. And then, the IPO process allowed us to get access to further resources. And we did our first major acquisition, acquiring one of our competitors, Australian Skin Clinics. And we'd also grown to about 62 with their acquisition of 56 clinics in September this year. That brings us to 118, which is where we're at as of today. We have footprints in every major state in Australia and New Zealand, and continuing to grow to hit sort of our mid to long-term goal of 150 plus clinics in this Oceania region.
That's fantastic. Thanks, Martin, and congratulations as well for the great start, certainly on the market. And as Stuart pointed out, and long may it continue. It sounds like a fantastic, great growth story. So I'll just go over to Brad now, just quickly. So I think you've probably covered some of it here, Martin, but I was going to ask Brad, what attracted Advent to Silk to find it out in the first place, and how did that all work out?
Yeah, thanks, David. In terms of the attraction to Silk, we'd had performed a lot of desktop research around this particular, industry. It originated from a kind of a research project which was called Appearance Medicine back in the day, and myself and the team had gone out and spoken to a lot of participants in the market. And interestingly, when we came across Silk, there were a number of kind of attributes that that we really liked about the business. The first one was that, you know, they had a willingness to partner, and indeed, prior to our involvement, Silk had actually, taken on some external equity with a family office based in Adelaide. So they knew about the philosophy of partnering and how important that was. If we looked at their kind of network of clinics as well, interestingly, they were quite strategic in where they were playing. So they had a dominant position in South Australia, a dominant position in Tasmania and the Northern Territory. So they were playing in markets which were, others weren't, and creating these kind of almost kind of regional leadership positions. So we thought it was actually quite an interesting platform. It was 12 clinics at the particular time to really build on that network and go either way across Australia. So look to partner with others and M&A on the eastern side of Australia, so the eastern states, and kind of organically push into Western Australia as well. One of the other things about Silk is that they'd reached that point where they had built the capability and expertise for cosmetic injectables. So most of the businesses in this particular sector, their genesis had been laser hair removal. And that was, a high kind of cash generative kind of offering. But to actually develop the infrastructure from a medical perspective, to be able to have the appropriate clinical oversight, that required a significant investment in kind of operating procedures, medical oversight. And Silk had the early stages of being, making those type of investments, and had reached a point where those cosmetic injectable kind of offerings were creating a larger part of the service mix. So we thought with Marty in the team, we thought that there was a real opportunity to kind of accelerate growth with the right partner and with the right backing and the right plan. I think the other aspect as well is Martin had a very clear vision for growth. When we met with him, he was able to articulate where he wanted to take Silk. And that was a journey that we believe we could support and facilitate. And I suppose, as they say, that the rest is history, from 12 clinics to 56 when we listed, and now 118. It's kind of a very powerful story about what growth private equity can do for an emerging dynamic organisation in a really interesting sector as well, which was growing at 15% per annum across various categories as well.
That's fabulous, Brad. And so it was 2017, was that right, when you got involved? And
it was January 2018 when we got involved, and listed December 2020.
Okay, great. So obviously that growth the initial growth happened with you involved in stewarding the business with Marty. But in terms of the exit paths that you were considering, with IPO versus other exits, trade sales, etc. How did Advent go about that decision making in terms of the exit?
Yeah, so there was a number of alternative, credible exit paths for Silk at the time of IPO, which were actionable. I think for us, it came down to assessment, collectively, is on a risk-adjusted basis, what was the best outcome for all shareholders at Silk. And I suppose one of the attractions for the IPO kind of exit was there was a partial, liquidity event for all shareholders. There was ability to put primary capital on the balance sheet, and essentially continue to execute the investment thesis that Martin and the team and Advent signed up to 3 years prior. So Advent knew the team, knew their ability to be able to execute, and had confidence about the go forward position. And with a residual stake as a listed company, we could participate in continued kind of upside in the business moving forward. So we were confident with Silk in particular as a a very interesting and unique asset that we were taking to the public markets. You know, there wasn't a pure play operator in this non-surgical aesthetics market, and an interesting kind of position straddling not only, you know, consumer branded, but also healthcare as well. I think Martin probably can attest to kind of the conversations that he had and the rest of the management team with institutional investors about this particular category, and being able to demonstrate some of the, you know, the favorable attributes of treatment plans and the repeatable nature of that engagement with the customer. And indeed, you know, the predictability of kind of performance as well. So we were confident that over time, as we delivered against that investment thesis, there should be some re-rating of, you know, how the markets thought about Silk and as they gained their understanding of the business model and Silk's unique position in that.
Thanks, Brad. Yeah, you jumped to one of the questions I'll be asking Martin a bit later on, but I just wanted to get Stuart's some of his technical knowledge in here. So just for the audience, really, typically, how long does it take for a business to prepare for an IPO? So I won't ask specifically how Advent went around their business with Silk, but typically, Stuart, how long would it take?
It really depends on how well prepared the company is internally. And one of the great things about companies having an investment from and growth capital from private equity is as well what private equity can bring to that business is institutionalization of the business ahead of heading into a market or a sale process. So making sure that corporate-wise, the business is well established, you know, from a corporate structure, from a legal perspective, all the agreements are signed up and are valid, and making sure that processes are in place that are needed for an IPO, and the governance arrangements that exist at board level. That obviously you replace the, you know, members of the board as you go into a listed environment, but the fundamentals are there in place. The accounting systems are all in place. So with that in mind, private equity can typically move, backed companies can move quite quickly. And preparation times, you know, generally we would guide it to around 3 months. It can be shorter or longer, but a 3-month time period in preparation. And then you move into formal marketing and of the transaction. And that in itself can take 6 weeks to 8 weeks, depending on what process you follow. So overall, you are looking at a time period somewhere between, you know, say 4 months at the tightest end out to about 6 months in terms of preparation for and execution of an IPO.
Great, Stuart. Thanks for that. Does that sound about right, Brad and Martin? That was kind of the timeframes you were working through.
Around
give or
that mark.
take. Give or take.
Take a few weeks.
Yeah, that's right. Yeah, pretty consistent. Pretty consistent. I do recall a conversation I had with Martin, which was, you know, we think that the IPO path is the right kind of path after, you know, considering kind of alternatives. And it was, I recall it being around July, might have been a bit earlier. Yeah, and Martin was thinking, all right, so we'd do it in 2021. I said, no, this year. So that was an interesting conversation. But to Stuart's point, the business was well prepared. We had the institutional disciplines there. That the plan was very clear, and so for us to move to become a publicly listed company, in many respects, it wasn't very different to kind of the environment that the company was operating in any event. A little bit more, obviously, public scrutiny now, but in terms of the disciplines in the business, they'd been established way back in, you know, from January 2018.
That's great. Thanks, Brad. So what I was going to ask Brad particularly was around the projections for the IPO sale. What were your thoughts on that when you were sort of marketing Silk at that time?
Yeah, look, it was a hot issue at the time because particularly for the ASX, given the uncertainty around COVID, and to Stuart's point previously, you know, around that time, there wasn't many, you know, businesses that are looking to go public, providing extensive kind of projections. So we were a bit unique in that regard. So we lodged a prospectus at the back end of November. And we went out with, essentially an FY21 projection, which is essentially 4 months actual and 8 months kind of, forward looking. We engaged with the ASX early as part of that. We actually, wrote to them and said, look, this is why we believe we've got a reasonable basis in being able to put a more long dated kind of projection out there relative to some others that were listing at the time or had gone before us. And that came down to a couple of factors. One, the business model of Silk, as I mentioned previously, there's a high amount of predictability with respect to clinic performance, just given the nature of the treatments that are provided to customers, either on, packages which are redeemed over a period of time, or alternatively, there's treatment plans which have an element of regularity about them. The other aspect was that, the vast majority at that time of our clinics were in South Australia, Western Australia and Queensland, which were less impacted by COVID. So I suppose the biggest threat to the projections was a shutdown, a lockdown and an inability to trade. We had a little bit of a curveball from the South Australian government on the 18th of November, where they brought in their circuit breaker kind of lockdown. So all retail closed for was meant to be for 7 days. I think it was the world's shortest lockdown because it ended up being 3 or 4 days in South Australia or something to that effect. But we were still confident that that wouldn't have a material impact on the projections, because what we found back in the March to May lockdown, the first lockdown, is that once we were able to open up our clinics, there was a significant bounce back in trade. So you almost recovered in many respects. Sometimes you exceeded kind of the lost days that you have in treatments. And the Silk team did a great job of being able to, run forward books in terms of bookings, being able to have those waiting lists and being able to really flex the labour to be able to support kind of extended trading periods, to be able to obviously recoup, some of those lost days as well. So as a board, we felt confident, notwithstanding that we were in an uncertain environment, that, we had a reasonable basis to go out to the 30th of June 2021. And, as history has shown, we've exceeded those prospectus forecasts. Indeed, we did an upgrade in December, I think it was, and then, exceeded even that revised projection as well. So that was obviously a good news story in that regard.
Great, thanks, Brad. Martin, over to you. We touched on this a little bit earlier, but did the IPO process reveal anything to you about how institutional investors thought about Silk and the business model and the industry?
Yeah, look, I sort of echo some of Brad's comments. We're quite a unique offering in the market at the moment in what we do. So look, a lot of us, even now in our first year, is really operational understanding of how our business works, education. If you think about our broad demographic, 93% or something like that of our clientele are females 18 to 55. Most of our institutional investors are men in their 40s, 50s, etc., majority. So teaching them about what we do, understanding about how we pivoted to repeatable services with which is where injectables goes, i.e. Botox lasts 4 months, then wears off and you're fighting aging. So, it's a never-ending battle. So for us, it's been really a learning curve. I think from my perspective, I've had 3 investments in our business, one through family wealth, second through private equity, and third through an IPO. The thing that I probably learnt the most is in all 3 situations, investors invest in the people and the story more than necessarily. They'll do their numbers and they'll do their modelling and obviously do their due diligence, but they really want to understand the story and management's ability to execute against that story. And that's been a really interesting learning curve for me, as we have lots of new institutions wanting to learn and understand. It's the same story, understanding about how we're going to go about executing this and that. So even now we're, a year into, we've got a great book of institutions and, we're talking to them on a probably monthly basis. But again, majority of that is around operational understanding and how you're going to do this and pivot that. then spend an hour or two with our CFO doing their modeling. But it's still, again, it's all around the operational understanding and management's ability to invest, which sort of goes back to sort of Brad's comments earlier around, and that's been a learning curve for myself in particular, is about backing management and backing the people to execute against that.
And in relation to your team, I mean, what were the kind of things you had to manage with them, once you went from private to public?
Yeah, it's not been too bad. Look, I try and become that cushion between my management team and the board and institution. But look, I've been doing that since 2018. So I sort of am in that sort of meat in the sandwich, if that makes sense, and ensuring, we have great disciplines, we have a board, we have good corporate governance. There's been a few extra dotting of I's and crossing of T's at board meetings. But apart from that, nothing from a day-to-day operational piece has changed. I suppose my team is a little bit more aware of being on a public market. So sometimes they might be a little bit more fastidious on doing X, Y, Z, but really day-to-day, nothing really changes too much because we were already doing that. And I think that's one of the reasons why we could execute against an IPO in a period of time that was fairly short for us, I'd say. It was within Stuart's sort of window. We're a fairly light resource team, and from a management perspective, we had myself, my COO and my CFO basically out of the business for 3 months, that July through to December, August through to December period, presenting to institutions to take the entire senior bench out of the business, and for the company to be able to succeed, do an upgrade and hit those numbers is a testament to the way the team presented and did very well. And again, it's pretty well same old. We're just head down, bum up and executing. And as long as we get our numbers, it all sort of works out the rest.
Excellent. Thanks, Martin. And with continuous disclosure, etc., did that generate a whole lot of extra work for your management team, or?
Yeah, look, continuous disclosure is an interesting one, and one that is always on the front of our board meetings to understand. And again, that's still a learning curve for me to understand of that continuous disclosure and when does that pivot point hit for that position. Again, I think that really is covered from ensuring that our board is aware and our board makes that executive decision with myself and my CFO and my COO. Again, I try and make sure that my middle management, my GM suite, are just focusing on what they're doing, but their communication is very strong through to us so that we can make those key decisions for that continuous disclosure. And, that was one of the reasons, for example, the upgrade of our results due to how well we were performing and ensuring that we had to present an upgraded results because we knew, notwithstanding a COVID lockdown of any long period, which, knock on wood, happened late June, not earlier, that we had to do that, for example. So that was one of those items.
Great, thanks, Martin. And Brad, I was just, whilst we were talking about the executive team at Silk, can you let me know about the considerations in relation to escrow agreements between Advent and the management?
Yeah, look, I think our escrow kind of considerations are typical of any private equity backed business and founder led organisation. So, from the private equity side of things, we don't want too much, held over. It creates an overhang in the stock in the aftermarket, but at the same time, we want you to have skin in the game. I think for the management team as well, it was communicating, I think, and there was a modest release for management, but it was communicating to those prospective institutional investors, and we could attest to this, that, Martin in particular hadn't taken, any money off the table as part of the Advent transaction, and here was an opportunity to be able to, personally kind of diversify his own personal balance sheet, but still, create a significant alignment kind of moving forward. So we arrived at a situation which is publicly disclosed. So, Advent had a 50% kind of release day one. The remaining 50% was delivery of the prospectus kind of forecast, so FY21 numbers, and then half year results for FY22. And management was 30% with the remaining kind of stake, 50% delivery of the prospectus forecast, again, equivalent to Advent, and then delivery of the FY22 numbers. So that seems like a healthy balance. As I said, previously in terms of the considerations of the IPO for Advent on a risk-adjusted basis. We made that assessment that we were happy to continue to hold shares because we believed in the upside and a re-rating of the business. So, that escrow kind of profile kind of worked with what we felt was in the best interest of our investors and how they could continue to participate in upside and the value creation kind of story. We were very confident on some of the other inorganic opportunities, able to execute, obviously, the ASC, Australian Skin Clinics transaction. And there's still a lot of room for growth with respect to the industry as well. So that all played into consideration of escrow and how that all worked.
Great, thanks, Brad. Just remind the audience if they want to send some questions through. I've got one more question, and then we'll go through to the audience Q&A. So just a reminder to send those through in the chat or the Q&A. But to Martin, so you probably touched on this a little bit, but it's just a final wrap up on, how's your day changed now that you're the CEO of a public company compared to a private company? And
yeah. Look, it's changing quite a bit, and it's probably changing as we're continuing to grow as our business. I'm a very operational CEO, so I really get in there with management and, as a small business CEO, and as we're growing to sort of a medium to large, my sort of day-to-day role is changing to being a lot more investor facing. So, we're constantly having new institutions wanting to understand, people wanting to cover the stock, and obviously talking to our existing shareholders and institutions as well. So, a good portion of my week now is covered probably 1 or 2 presentations a day in regards to talking to institutions and investors about the company, and obviously going on potential roadshows on Rapid Insights. Wilson's, for example, is one of them. Morgan Stanley did one the other day as well. So my role is definitely changing, and with that, it was expected, and I'm enjoying it for what it is. It's a very different role to what I'm used to, but that's all part of my learning journey. And, one thing I've realized as your company grows and, going from small business to medium to potentially large is it's about having great people around you and making sure you have faith and trust in those people to execute against the strategy. And my role is more sort of setting that strategy and making sure my management team are on part of that journey to give them belief to execute against the story that I'm presenting to the institutions that are investing in us and our shareholders.
Great, thanks, Martin. Okay, well, I'll wrap up the panel there. We do have a few questions coming through from the audience, which I'll jump to. But thanks, gentlemen, for the Stu, for the presentation at the start and for your contributions in that panel chat. So thank you very much. So a question for Stuart has come through. What does investor sentiment towards PE-sponsored IPOs look like today as compared to a few years ago?
PE sentiment is really, it's ultimately company by company. So the investors will approach each investment with looking at what is the business in which I'm investing. So they don't take a view which says, oh, it's PE backed or not PE backed, I take a different position. It's very much driven by what is the company that's being presented to me. And Silk Laser is a great example here, that it's a business they'd not seen before. There wasn't an opportunity to invest in the market. It had great growth opportunities in front of it, had a strong management team that had successfully built the business over time. And so they looked at that business as a standalone business. What does it look like? And then follow on from that was the comment that Brad talked about beforehand is, okay, well, what does the office structure now look like? What is Advent selling out of, or what is PE selling out of? What are management doing? And then are we comfortable with that sort of structure that creates appropriate alignment for the business going forward while ensuring that there's adequate liquidity in the story? So I think, when we look across the board, sentiment towards PE-backed IPOs is good because they're looking at the business itself. So and I think, you've seen that in terms of the businesses that have come to market out of PE-backed businesses this year or last year. There's been some very good businesses that have come to market. There's a couple that are in front of investors right now as well.
Great, thanks, Stuart. We've got a couple of sort of technical kind of questions as well. One of them is, what role do the brokers play in an IPO? Is that for you, Stuart, I think?
Yeah, I can start, and then maybe Brad or Martin might want to chip in from some of their recent experience. But essentially, the primary role of the brokers is to facilitate the engagement of the company with the institutional investors, and then actually secure investors for that company at a price point that the company is willing to transact at. So they will help prepare the company alongside other advisors, prepare the company for IPO, and then start the education process with the institutional investors. And we can't forget retail as well. That's an important element of any allocation or any sort of shareholder register. Is it a balance between institutions and retail? Ultimately, it's the institutions that really drive the price setting mechanism. So they tend to get a bit of focus, particularly at the back end of a transaction, when it's coming to how do we actually now bring together all the feedback that we've got from the marketing that we've been doing to retail and institutional investors. How do we bring that together to then put a pricing in front or a range in front of institutions that the company would be accepting to transact at, and that institutions are prepared to bid within that range. And then ultimately the brokers create a book build or an auction style process where institutions and retail can bid for the shares that are available, and based on that demand that's achieved, they'll then make a price recommendation to the company and an allocation recommendation. So overall, it's about taking a company that is private and putting it into new shareholders, being both institutions and retail, through their networks and relationships.
Brad or Martin, want to add anything to Stuart's response?
Look, the only thing I would add is that, in terms of selecting a broker to support this particular journey, what was important to Martin and Advent was obviously the marketing kind of narrative and being able to understand the business model. Having some conviction around where, price would land. Making sure that the mix of institutional investors supported kind of the long-term kind of aspirations of the business. We were looking for investors that wanted to come on the journey as well, which was important. I think the other aspect is just, aftermarket support as well, and being able to provide, continued education opportunities for the market to cover the stock, and also be thinking, post IPO as well. And I know that Martin's found that's been quite useful with that relationship, which shouldn't necessarily, cease immediately post IPO. And for the ASC transaction, there was a placement which was done, which was great to have the support of the existing, brokers as part of the IPO process. So we see that as not a transactional relationship. It's something that should be ongoing. So I might pause there, just get your perspectives on that piece in particular, Martin.
Yeah, definitely. Look, it's pretty exactly right. I mean, we had a fairly robust process for selecting our stockbrokers, and we had a couple that we ended up going with. And, the longer term relationship with them continues. I probably still speak to them on a very, very regular basis as we're sort of, continuing our next growth story. Obviously, they were very key in our acquisition with Australian Skin Clinics with another placement. And obviously the quality of our institutions, which to Brad's point was critical for our success, and institutions wanting to buy into our longer term story. So yeah, I think the one thing is with the stockbrokers, we obviously selected, we believe, very well with stockbrokers that would have a longer term relationship with us, not just at IPO, but moving into a longer period of our continued growth story. So it's been really key for myself as a newly listed CEO and my journey as well for the companies.
Great, thanks, Martin. Look, we've got about 3 minutes left. I've got one question here which might take us to the end, but if anyone's got a burning question to send along, please, you might be able to squeeze it in at the very end. But it's a question for Brad. Is the overhang issue that you mentioned something that you think all PE firms have now accepted as part of the equation for taking an investee company to IPO? Because a few years ago, the need to retain a stake post-listing was not necessarily the normal practice.
Look, it feels like an overhang or, an element of retained stake is important to provide, comfort to institutional investors that, you believe in the growth story moving forward. So, as I mentioned, that was easy for us with respect to Silk because it was one of the considerations in terms of that continued participation in the upside. So, look, I am, we are seeing that as a feature of kind of requests from institutional investors. Now, I've got a number of data points on that, but probably defer to Stuart a little bit about what the market is kind of seeing. We were comfortable in this situation. We're comfortable in most. Integral Diagnostics. There was a large stake that was obviously retained as well. I'm sure it's a bit of horses for courses, but that's my sense that alignment's really important for institutional investors, that you're going to be there, obviously post delivery of at least the first annual kind of results of the business. But Stuart, look, I'd be interested in your perspectives on that.
Yeah, I agree completely. If you look back in the 2000s, and the listings that happened there, PE would exit completely, and it was institutions saying, I don't want an overhang, I just want PE out because they're not long-term holders in the story and in the company. Since the IPO markets reopened, and globally, it's always been that private equity would retain a holding. US and UK, they would always retain a holding in IPOs. When the market reopened in 2013, and since that time, so we're now talking 7-8 years, it's been virtually every deal has seen private equity retain a holding, and that has been really very well received by investors. And the sort of, I think, Brad, your comment around what you did in Silk laser clinics is exactly similar to what we see across the market more broadly, which is around half. PE can sell up to sort of half their position, and management around up to, say, 30% of their shareholding, creates appropriate liquidity in a good alignment. And importantly, what we have seen is in future sell downs that have been done post-listing private equity, they have been really well managed. So we've seen them executed cleanly. We've seen them executed at quite tight discounts. Sure, the market's aware that an escrow is coming off and there may be a sell down coming, but it has actually been quite a smooth transition for private equity selling it into an IPO, retaining a holding, and then if they want to, selling down over time. So it'll be a feature that will continue moving forward because I think it's working well in capital markets right now.
Perfect. Thanks, Stuart. Thanks, Brad, for responding to that one. Look, we're right at 11 o'clock now, so I'll wrap up proceedings there. But thank you, Stuart, Brad, and Martin for your time this morning. Very enjoyable session. I hope the audience took a lot out of that and got a lot of new knowledge to take away and think about in their roles moving forwards. But thanks so much, everybody, for joining today, and particularly to our presenters. And we will be sending a survey, as I mentioned, so if you could respond to that, that would be fantastic. But please enjoy the rest of your day and see you later. Thanks. Bye-bye.
Thanks, David.
Thank you.
Bye.